Every time oil prices spike, the same economic rule triggers chaos across the world. Once you see it, you can predict every oil crisis before it happens. Oil crises look unpredictable. Prices spike suddenly, markets crash, inflation rises, economies slow down. But behind every oil shock, one economic rule repeats again and again. That rule is simple. When supply tightens and demand stays high, prices explode. Then the shock spreads through the entire economy. This is not new. It happened during the 1973 oil crisis, the 1979 oil crisis, and during the 2008 global financial crisis. Each time, the trigger looked different, but the mechanism was the same. Oil sits at the center of the global economy. It powers transport, manufacturing, agriculture, and trade. It affects food prices, shipping costs, and electricity bills. Because oil is embedded in every industry, a price shock never stays contained. Start with the core principle. Oil prices are shaped by supply and demand. When supply is stable, prices stay predictable. When supply falls or demand surges, prices rise. But oil markets have a unique problem. Supply cannot respond quickly. Oil production needs drilling, infrastructure, and time. Demand, however, can spike quickly due to growth, conflict, or weather events. This mismatch creates vulnerability. Now look at the first phase of every oil crisis. A supply disruption or geopolitical shock appears. It may be war, sanctions, production cuts, or natural disasters. Even rumors of supply risk can trigger price movements. The market reacts instantly. Traders push prices higher. Futures markets amplify the effect. Fear drives speculation. At this stage, prices rise faster than actual shortages. The psychology of markets magnifies the shock. The second phase begins when higher prices reach consumers. Fuel becomes expensive. Transport costs rise. Airlines, shipping companies, and logistics networks face immediate pressure. This cost is passed down the chain. Retail prices increase, manufacturing costs rise, food becomes more expensive because agriculture depends on fuel and fertilizers. This is where inflation starts to accelerate. Once inflation rises, central banks step in. They raise interest rates to control prices. But this creates another problem. Higher interest rates slow borrowing. Businesses delay investment. Households cut spending. Growth slows. This creates a dangerous mix. High inflation and slowing growth. Economics call this stagflation. Stagflation is hard to fix. Raising rates fights inflation, but hurts growth. Lowering rates helps growth, but fuels inflation. This dilemma appears in every major oil shock. Now examine how oil shocks spread across economies. Consumers change behavior first. They reduce spending on travel and discretionary goods. Businesses face falling demand. Companies cut costs. Hiring slows. Some industries face layoffs. Energy-intensive sectors suffer the most. Aviation, transport, chemicals, and manufacturing feel immediate pain. Financial markets react next. Stock markets fall as earnings expectations decline. Investors move to safer assets. Bond markets fluctuate as central banks adjust policy. Currency markets react too. Oil-importing countries see weaker currencies. This makes imports more expensive, worsening inflation. The cycle reinforces itself. Higher oil prices weaken economies. Weak economies reduce demand. Eventually, demand falls enough to bring oil prices down. This is the correction phase. But before correction, economies often face severe stress. Now consider why oil crises repeat despite lessons from the past. First, the world remains heavily dependent on oil. Even with growth in renewables, oil still powers most transport and industry. Second, spare capacity is limited. When global demand is high, producers have little room to increase output quickly. Third, geopolitics plays a major role. Many major oil reserves lie in politically sensitive regions. Conflicts, sanctions, or instability can disrupt supply. Fourth, investment cycles create volatility. When oil prices are low, companies reduce investment. Years later, when demand rises, supply cannot keep up. This cycle creates boom and bust patterns. Now look at real historical examples. During the 1970s, geopolitical conflict reduced supply. Prices surged, inflation soared, growth slowed. The pattern matched the rule. In 2008, demand from fast-growing economies surged. Supply struggled to keep pace. Oil prices climbed sharply. This contributed to economic strain before the financial crash. More recently, supply disruptions and demand recovery after global lockdowns pushed prices higher again. Each time, the mechanism stayed consistent. Now focus on why oil is so powerful. Unlike other commodities, oil has no immediate substitute in key sectors. Trucks, ships, and planes still rely heavily on oil-based fuels. Switching to alternatives takes time and infrastructure. This gives oil unique influence over economies. Now explore the psychological factor. Expectations shape behavior. When people expect higher prices, they act early. Companies stockpile fuel, investors speculate, consumers panic. This pushes prices higher even before real shortages appear. Markets don't wait for physical shortages, they react to perceived risk. This creates self-fulfilling cycles. Now consider the role of governments. Governments try to stabilize markets using reserves, subsidies, or policy changes. Some release strategic reserves to increase supply temporarily. Others adjust taxes to ease consumer pressure. But these measures offer short-term relief, not long-term solutions. If the underlying supply-demand imbalance remains, prices rise again. Now examine global inequality in oil shocks. Oil exporting countries often benefit from higher prices. Their revenues rise, government budgets improve. Oil importing countries face pressure, trade balances worsen, currencies weaken, inflation rises faster. This creates global imbalance. Developing countries suffer the most. They spend a large share of income on energy and food. Price shocks hit them harder. Now look at structural changes. High oil prices accelerate innovation. They push investment in renewables, efficiency, and alternative energy. Electric vehicles, solar, wind, and energy storage gain momentum during oil shocks. This long-term response reshapes economies. But transitions take time, and short-term pain remains unavoidable. Now examine the modern energy landscape. Global demand remains high. Emerging economies continue to grow. Transport needs increase. At the same time, investment in new oil supply has slowed in some regions due to policy shifts and climate concerns. This creates risk of tighter supply in future. If demand grows faster than supply, another price spike becomes likely. Now look at what happens inside economies during a crisis. Households adjust budgets, savings fall, debt increases. Businesses face rising costs and weaker demand. Profit margins shrink. Governments face higher spending needs and lower tax revenues. This stresses public finances. Now examine central banks again. Their tools are limited during supply shocks. Interest rate changes cannot increase oil supply. They only influence demand. This makes oil-driven inflation difficult to control. Now consider the tipping point. If oil prices stay high for long periods, economies enter a recession. Demand falls. Eventually, oil prices decline. This correction restores balance, but often after significant damage. This boom-bust pattern defines oil cycles. If you want clear explanations of global economics, energy systems, and world events, subscribe to our channel. You will get deep insights explained in simple terms, helping you understand what drives the world economy. Now return to the core idea. Every oil crisis follows the same economic rule. Tight supply plus strong demand equals rising prices. Rising prices trigger inflation. Inflation slows growth. Slower growth reduces demand. Lower demand eventually bring prices down. This cycle repeats. The causes may differ each time. The mechanism stays the same. Understanding this rule helps predict future shocks. When you see supply risks rising and demand staying strong, expect pressure on oil prices. When oil prices rise sharply, expect inflation and economic strain. This rule is not opinion, it is pattern. The world may change, but the structure of oil crises remains consistent. Now think about the future. Energy transitions may reduce oil dependence over time, but until alternatives fully replace oil, this rule will continue to shape economies. The next oil crisis may look different in detail, But the economic chain reaction will be familiar. Supply tightens, prices rise, economies feel pressure, demand adjusts, prices fall. Then the cycle begins again. Oil is not just a fuel, it is a pillar of the global economy. Every time oil shocks the system, the same economic rule plays out. Once you understand this pattern, you stop seeing oil crises as random events. You start seeing them as predictable cycles. That knowledge helps you prepare. It helps you understand headlines, markets, and policy decisions. Because in the end, every oil crisis follows the same economic logic, and that logic is the key to understanding the world economy.